Hey, dividend growth and value investors. Ahold Delhaize just did it again, guys. This European dividend darling just announced its 16th consecutive dividend hike on the back of really strong earnings. They hiked their dividend by 10.5% to €1.05 per share. This lifts the stock to a 3.5% dividend yield at the current price. Their 5-year compounded annual growth rate is with that 10.7%, and their current payout ratio is 41%. Come on, guys, tell me. This sounds great, doesn't it? Well, let's also have a quick look into their earnings to see how they've been pulling this off, followed by a quick update on my assessment of the company. Guys, let's get started. So look, the main highlight here is net sales of 87 billion, an increase of 6.9%. This is really amazing, and what it tells us, they have been able to pass on the inflation to the customers. This is something that not many companies can do, but Ahold pulled it off. They were able to score a 2.55 euro in EPS, which is a 16.5% increase. I must confess, last year they had a bit weaker earnings over 2021, so it's not too difficult to hike it with this much the earnings, but still it's an amazing number. What I also like is that their underlying operating margin is 4.3%, while their goal is 4%. So they've been really impressing themselves. And here I want to highlight one thing, and I mentioned it maybe also several times on the Dividend Talk podcast. This is a company that uses the UPOT methodology, the CEO. UPOT stands for under promise, over deliver. And I want to show you really what I mean with that, because look at this. These are their most recent guidance and targets. 4% operating margin, 4.3%. Low double-digit growth, so that means like 10, 11%, 16.5%. CapEx 2.5 billion, less 2.2 billion. Free cash flow 2 billion, 2.2 billion. Dividend increase 10.5%. Share buyback as per expectation 1 billion, and more savings to their customers. One of the reasons why the free cash flow was up was because of lower CapEx and higher cost savings for their customers as well. So in my opinion, this shows just how strong this company is to deliver above expectations, and we should not take this lightly. This just shows that they have excellent management, and it's not a one-off. I'm following this company already for a few years, and it's every single year the same under the current CEO. Now, how did they get to this? Maybe a little bit looking one level deeper into the earnings. I mean, it's the US. It's really the US that was the strongest growth driver here. In quarter 4 of last year, they made 9.3% growth compared to the year before in the US. Compared it to the Europe, 5.7%, but overall for fiscal 2022, only 2.9% growth in Europe, while in the US, 6.9%. So this is really where you can see where the strong earnings growth is coming from. So thank you if you're from America. I really thank you for paying higher bills, because it has given me a 10.5% salary hike via the dividends. Having said that, there was maybe one little underwhelming point in their earnings report, and those were the earnings from bol.com. They had the sales of 2.7 billion, which was 3.2% less than last year. If you don't know what bol.com is, because you're not unfamiliar with it, this is the Dutch Amazon. It's the biggest online retailer. You can get there everything like people are used in the States or elsewhere when they think and shop at Amazon. So this is the Dutch variant. They're also operating in Belgium. Really huge. I don't know anyone from my family or friends that is not using bol.com. This is not entirely a surprise, because last year they gave already some guidance that they are going to reinvest more in the business, also to keep it set up for the future. And still, while it was down 1.9% against a market which declined around 6% according to the CEO, we consider this still relatively good earnings. I have a little bit of a bad taste about it generally, because they wanted to do a spin-off last year. Of course, they didn't do it then because the markets didn't look good, but why not a year earlier at peak earnings and peak market? They were probably a bit too slow in execution, but still, these are still like crown jewels in the assets, and I believe these are not priced in even in the current value that the company represents. Having said that, there's maybe one or two items that I still want to show. Let's look at the dividend policy here as well, because I want to really highlight that to you. While they grew their dividends around the 10.7, so 11% CAGR over the last 5 years, this is really unique to see in the European earnings reports, that this reflects our ambition of a sustainable, and here it is, growth of the dividend share. Really, you don't see this a lot. There are a few companies that really mention this in Europe. Usually those are the heavy low yielders with high growth, but this is still like a 3+% company, which is really outspoken about this. They have a target of 40% to 50% earnings per share payout ratio, but there have been years that they have been slightly above that. Still, they were growing the dividends. So it shows to me the commitment that they have. Hey, having said that, also let's have a quick look still at their outlook, what they are aiming for. And for this year, in 2023, they are again mentioning 2 billion. Remember, we're talking here about 1 billion buyback, 1 billion dividend. Free cash flow is entirely going to the shareholders. This is already after spending their capex. So for me, I'm pretty okay with this, because what I will show you now is also the power of that. Because this company scores a very safe dividend score in our dashboard. It's mainly because of all the metrics here. The only reason why it's a little bit lower than 100 is because of the balance sheet. The balance sheet, they have a debt equity ratio of 100. I'm not concerned about that, because this is a retailer. They have really predictable cash flow already for years, 2 billion. They can easily pay the debt at 10% or at 10 times interest coverage. So this is normal in the retail industry. I'm not worried about this. But if you look here at the trend, in 2015, they merged with Delhaize, the Belgian variant. That's why it's called Ahold Delhaize right now. The shares went up to 1,281. In 2022, they have only 986 million of shares left. That's on the back of a 1 billion almost share repurchase per year. You can see that here. A little bit more in 2018. They had a bit of a windfall. Having said that, just comparing with last year of 1,023 million shares outstanding compared to now, this is already a decline of 3.5%. So this 10.5% dividend hike that we saw, take 3.5% buyback off of that, and you have 7% real hike that we're experiencing here. This is the beauty of buybacks when done well, because the multiple is around 12 to 14 all the time when they're buying back, and this really gives you a good return on investment. Having said that, the stock, in my opinion, is currently fairly valued. The share price is 29.70 at a fair value of 30 euro and 60 cents. How have I done this? Well, I believe it's fair to trust the company here and leverage and use the 2 billion free cash flow annually going forward. Take into that account a 5% growth, which is a relatively low growth because it's a slow growing business, 3% thereafter in the next 5 years thereafter at a 10% discount rate. I'm not going to use here 12.5% or 15% because this company is really stable, not so sensitive to the economic circumstances. Actually, they are a defensive company and they will do well also in an economic crisis. Terminal multiple that it deserves, in my opinion, is 14. So hence the fair value of 30 euro and 60 cents is entirely valued here. You see everything is almost in green except for the debt equity and the return on invested capital. I would like to see this a bit higher, but if this is the only one, I'm keeping a blind eye to it. So what am I doing? It's already my 5th position in my portfolio. So I'm not adding aggressively to this one. I will, however, continue hitting the reinvest button as soon as the shares hit my, the dividends hit my account to really benefit from the compounding. And this company I would like to buy therefore because I own already a lot of shares at a 10% discount. So I would actually consider buying again at 28 euro if it drops there. My former buy zone was 25, so after these earnings I will be increasing it to 28 euro and consider me buying there. Guys, hey, if you like this update about Ahold, please don't forget to like the video. If you haven't subscribed yet, please consider so. First of all, you make a smile on my face. Secondly, I hope it will give you more value in the future. Guys, see you in the next video.